Hi, Jennifer Warren here, and I'm going to give an overview of a talk that I'm going to be giving at an investor conference in Austin during the time of South by Southwest. And I just wanted to present a little bit about the energy transition, or the post-ESG world is what the title of the panel is, and then also kind of seg into some of my advisory work. So I'm calling this The Color of the Energy Transition, a Texas Point of View. And sort of where the action is right now is, the big story is oil and gas consolidation. And there have been many hundreds of billions spent, even in the last 6 months, for this industry consolidation. Now, it didn't just start all of a sudden. Back in 2021, right as we were on the heels of the pandemic, I had worked on this feature and interviewed Scott Sheffield for an article that was coming out in the fall of 2021. And even back then, he was discussing that there was going to be consolidation coming in the industry. Now it's really afoot. And this was the edition where he was, called the king of the Permian Basin, which has been true. And then the other thing I want to note is that a lot of the large firms, the large scale incumbents in the oil and gas world, are the ones that are, buying up other independents in the Permian and other parts of the country. Especially notable is the Exxon Pioneer acquisition, the Chevron Hess acquisition, the Diamondback Endeavor acquisition. And something that I see playing out is just that there are with these large scale incumbents, there are infrastructure network effects. And something that I wrote about in just last fall was about Energy Transfer and how they had to rework the pipelines in the United States to connect a lot of the shale basins, so that we would now become this energy powerhouse that we are, and this large exporter around the world. And this was the story, the pipeliner's dream. And so these things have been in the works for quite some time. The other thing too, I want to notice, because this is an investor conference, is that public markets are a little less enamored with green as marketing, marketing investments in that way. They're getting smarter, and they expect performance, and they expect profitability to be delivered. And the other thing I want to note is that even though the weight of the world's energy demand is in the fossil fuel camp, like over 80% of our primary energy is fossil fuels. Low carbon energy investment surged up to 17% last year, reaching $1.77 trillion. There's thousands of projects globally around the world in clean energy. US spending 300 billion, China spending twice that, the EU 340 billion, Japan 32, India 31. The other notable trend with this industry consolidation is that I see it as being driven by efficiency, capital efficiency, asset efficiency, a reshuffling of assets within basins and between basins, depending on the acquiring firm. And I think also these oil and gas companies are rethinking their future value propositions, because they know that there is a lot of, pressure to decarbonize. And so they have to really come to terms with, how are we going to produce oil and gas efficiently? How are we going to win shareholders, investments, and keep them? And what are we going to have to give them in return, which is returns. And right now, a lot of it is dividend driven. And I have an interview with Jay Hatfield, who runs an MLP ETF, and we delve into a lot of what's going on with investors in the space. The other thing that's positive about this industry consolidation is that a lot of innovation can come, because these firms are highly capitalized, and they are the ones spending heavily also on low carbon solutions to do with sustainable aviation fuels, CCS, and enhanced oil recovery. And I think we're just going to keep seeing that advance as firms try to produce more from an individual well. Right now with shale wells, it's like up to 8 to 10% recoveries. What I have heard, and I know that Exxon with Pioneer has plans to, like, try to double that. And who knows, it could get higher in the future as well. Maybe AI will come to the rescue and come up with some solutions about that, because they have a ton of data. And I suspect the oil field services firms will be they already are very heavily invested in this as well, optimizing performance of wells and all that. The other thing too is that there are a lot of small niche firms that are arising to solve some of the problems to do with decarbonization, the desire for cleaner molecules, grid challenges with integrating gas and renewables, wind, solar, and nuclear, whatever a grid comprises. There's a lot of opportunity to do this better and smarter. And we definitely see these headwinds in the ERCOT grid in Texas. But there's a lot of innovation happening as well, both with centralized and decentralized approaches. So the big news, with hydrocarbon, the drivers, is that developing world demand is what's driving the growth, and the continuation of there needing to be I think it's 103 to 104 million barrels a day demanded this year, and it was 100 million barrels a day right before the pandemic. So oil demand has not dropped. OPEC believes that it will peak in 2045 roughly. The IEA, which is the Paris-based organization, believes it's going to peak in 2030. So those are two very different worldviews of oil demand going forward. The other big story, again, is the Pioneer acquisition, Exxon Pioneer for $60 billion. The Permian, which is where, Pioneer's assets are, and that's the largest oil field in the United States. We're producing about 6% of global supply. And that's, some are heralding us to be in this shale 4.0 era. And that's to do with efficiency again, and tech and innovation in the shale field. So that's all going to be TBD. With the Diamondback Endeavor acquisition, which Diamondback bought Endeavor, which was a private producer, for $26 billion, and it creates one of the largest independents in the Permian. I believe that merger is still, happening. And then Chesapeake Southwestern was a $12 billion acquisition, creating the largest natural gas player. Natural gas is in high demand. Demand will continue to grows faster than oil for all kinds of reasons. And a lot of it has to do with power generation and the increased need for electrification across the globe, especially with developing countries, and the fact that renewables cannot meet all that demand of the grid. And in the second half of the 2020s, the big LNG story is Asia, trend-wise. And developing world demand drives the growth of natural gas up to 2040. And the majority of this growth is driven by Asia. The US LNG has added liquidity and depth to a market which did not exist before. And that was from Baker Institute's Ken Medlock, who said it at a Fed conference that I attended in the fall. And there's really a lot to that. And we do see that playing out on the Gulf Coast heavily, in spite of the Biden pause. That's only supposed to really impact projects in the second, sort of like after 2027 for a few years, if that pause, in fact, stays a pause. Texas economy, which is where we are here and where this investor conference is, we're still running a bit warm. Our exports here, which has been a big contributor to our GDP, is largely energy related. US LNG accounted for almost 20% of the volumes imported globally in 2022. So we're sending a lot of LNG around the world. And that was the year that Russia invaded Ukraine too, by the way. In Texas, in combination with Louisiana, was $315 billion in energy exports. That was 83% of total US energy exports. So Texas has the absolute outsized proportion of energy exports in the country. Also in Texas, we're the #1 solar state. We have 12 gigawatts of nameplate capacity, and 16% of US capacity is in Texas. So that's really a huge proportion. We are also #1 in wind. And then I want to note that because of all the addition of renewables, which has caused, stress on the grid, because of reliability issues, that congestion has cost $3 billion, I believe, in 2021 or 2022. And so then the final thing I do want to mention is just that, with a lot of the LNG activity, and Shell came out with a report discussing, how emissions reductions can look in LNG. And there's a lot of opportunity to reduce methane emissions, which is very much on the books. And most, if not all, publicly traded oil and gas firms have serious targets to, significantly reduce their methane emissions. To reduce these emissions by 100%, nature-based approaches are possible via bio-LNG. The other 100% compensating for the emissions is through offsets credits. At present, I don't know that there's enough credits in the world for that. And then the other thing is that CCS can reduce by 80% the methane emissions in LNG. And next, I just want to show some slides of some work that I'm excited about, and I'm going to skip to that. So this is just a picture of the shale basins here on the right-hand side of the United States. Here's the Permian right here. Up here is the Bakken. Over here, Appalachia, Mid-Continent region. And this is a picture of the Turkey Track Ranch. And over here, these words are, in fact, part of a global marketing campaign that I was part of. So skipping all that, because we've just covered it. So this is my, what I call my natural capital practice, but it's, within Concept Elemental, it's just a sort of like a specialty connected to resources. And I've always had this interest in connection to nature resources. And then with my background in economics and finance and marketing communications, this is just kind of grown over time. I think chronicling the shale basins and looking at these resources over the last 15 years has absolutely played into some of my understanding of how resource efficiency looks, how investment flows, and what is possible in the future. So the other thing I just want to say is that with this natural capital practice, hopefully this will be my contribution. I believe it can be a place of impact, and I just want to show some upcoming work. This is actually a large-scale real estate land development, and it's got a lot of the features of my natural capital practice. There's a lot going on there, and I will detail it here in a second, just a little bit. This is coming out in late March, so early days yet. But what I want to just say from my natural capital lens is that, this approach lends itself to complex and asset-rich situations or nature-based initiatives, and it's very context-specific. One example, it was the natural capital of a large-scale historic Panhandle ranch. where I assess the salient attributes and assets with expert commentary. The other project is a large-scale circular economy development that is in the Texas Triangle, and it is multi-layered. It's a multi-layered development, and I'll be excited when I can kind of talk about it in more detail. This is just kind of a view of it. So I will stop sharing. Thank you for your time. Appreciated it.